Hello, my friends. Brett Pattison with IronGate Global Advisors coming at you from the financial capital of the West. That, my friends, is Salt Lake City, Utah. Thank you for taking a few minutes of your time to spend with us today as we talk about the month of May and a famous phrase that everybody talks about this time of year, which is the phrase, sell in May and go away. We're going to talk about, is it really sell in May and then go away, or what should you be doing? We'll also have a special visitor today. My partner at IronGate Global Advisors, Brian Hunsaker, will join us just for a minute to share and impart some words of wisdom to all of you. But I'd like to first off apologize. We're a week late in getting this video out. I was in San Diego last week meeting with some of our tremendous IronGate Global Advisor clients. Great people. They know who they are, and it was a pleasure seeing them face to face. Just because we're based out of Salt Lake City does not mean we cannot manage money wherever it may be, of course, and we like to get out and meet people. So it was fun doing that. And so sorry that this video is a week late, but I want to discuss some very important things, starting with our process and really reminding you about our process for investing. Our process is driven not by results. And we don't focus on results and say we need 10%. We focus on the probabilities of making money. We have a process in place that focuses on buying stocks and selling options that have a higher probability of winning than losing. Not that it's guaranteed, but we know that as we follow our process, that results will come. That's how we manage our money. All right? And that will directly impact our discussion today. First off, let's take a look at where we are year to date in 2016. Top of your screen in that little box, you'll see the S&P 500 is squeaking out a gain as it stands now. And highlighted, I have the three top performing sectors of the year. Starting at the very bottom with utilities, which is an interest rate sensitive and more defensive sector, has been doing really well. Energy to follow, and energy has rebounded. The price of oil has rebounded, and we've seen that in the prices of energy stocks. And, of course, materials as well. And think of gold and silver, which are starting to rally. Really, really interesting what is happening. Either defensive names are outperforming, with staples, of course, up almost 6%, or something tied to commodities, because commodities have just been hammered, whether it be oil or gold and silver, and they're starting to finally show some strength. And so those are the sectors that are outperforming so far year to date. That does not mean they will continue to outperform, but that's where we stand now. So let's talk about history for a moment. We talk about the probabilities of in our process. Part of our process is understanding history. The history of the markets and what typically happens from a historical perspective. For example, we are value investors. We don't look for those high-flying stocks like the Teslas of the world and buy those things that everybody loves, but we look for those names that and stocks that most people don't like. And then we find out, through our process if they're good investments or not, if they'll grow over time. And why do we do that? Because it works. Historically speaking, and data from Morningstar and other providers show us that value investing outperforms over the long run. That's why we do it, right? And so as we look at history and we look at the month of May in particular, we need to understand what typically happens in a normal cycle in the month of May. And that is this. The average S&P 500 return since 1950 is 0.1%. So in the month of May. So May typically is a flat month or a barely up month, call it 0.1%, right? And so how can we take advantage of a month that we know historically and a good probability that it's going to be a little bit more sideways? Okay, that's part of then this is a small part of a larger discussion. And I bring up the next slide to show you what that larger discussion is. We have sector performances On the far left, you'll have your S&P 500 sectors. At the very bottom of the slide, of the table, you'll see highlighted in red the S&P 500 itself. Okay, now the middle column shows you what the average returns are, again, since 1950. The average return, and you can even go back further than that. You can go back to the early 1900s and see that the data still holds. But those are the returns from November to April, the average returns for that particular sector. So, for example, consumer discretionary from November to April really does well. It averages about 11% return. And industrials is about 9.7 and materials is 10.1. Now that's on average. And so we know if we want to outperform the market, which is at 7%, then maybe, this is not a recommendation, but maybe we should think about overweighting certain sectors. Okay, now that's November through April. We're done with November through April. So as we look at May through October, which is that next 6 months, again, sell in May and go away, or sell in May and reallocate, perhaps, we can look at two sectors that typically do really well May through October, and that is consumer staples and healthcare, both defensive type sectors. And the market itself, the S&P 500, averages about a 1% return in that May through October timeframe. So historically speaking, most of your returns, just looking at the market, come in that November through April timeframe. If you want to overweight certain sectors May through October, perhaps we look at those sectors that are outperforming. And that's what we would look to do in the month of May through October. And so let's go to and summarize what happens in May, all right? And what should you do in May? And everybody's a little bit different, and everybody's portfolio is a little bit different. So don't take this as a recommendation that you should go and do exactly what we say, right? Call us, talk to us, we'll walk you through it. But the first thing that we have in our portfolio that makes up the larger portion of our portfolio is value stocks. And in May through October and in April through November, we do nothing with these value stocks. We perhaps sell covered calls, but we don't buy our value stocks for 6-month returns. We don't buy them for 1-year returns. We buy our value stocks for 2, 3, 4, 5+ year type returns. And so we're not going to do anything in May with these value stocks. We'll just sit. We'll just wait for them to work. And perhaps they will work in the month of May, June, July, August, right? Through that time frame. So value stocks will do nothing. Perhaps we'll sell covered calls. Depends on the individual's account, tax consequences, different things like that. So let's look at sectors. What do we do with sectors? Well, we're going to move, as we just talked about in the prior slide, we're going to move to more defensive sectors. We're going to sell the cyclical sectors, discretionary, industrials, and we'll look to move into those sectors that typically do better that time of year. Staples, healthcare, right? That's what we're doing. We're doing in many client accounts. Again, doesn't mean that's what you should do. Call us. We'll talk to you as to whether you should or not, but that's what we're doing in a large portion of accounts. Now, the last thing that you should do in May, options. And we say sell, 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 because if we know with a high probability of success that these months are going to be a little bit more sideways, then it's a great time to sell options. And one of the words of wisdom from my partner, value stock guru, he's laughing, but it's true, Brian Hunsaker. He's been in the business 25 years. He's never been on this market commentary before, but we were listening, and we're big Buffett fans, and we were listening and watching Buffett's annual meeting that was streaming on Yahoo. And a few of the principles that we talked about in the office are what I think it's important for everybody to hear. Brian, I know a couple of those things stood out to you as well.
Yeah, Brett and I, we talk all the time about, things that we think that would help our customers be better investors. And in fact, this past week, Brett and I met with a customer, and one of the things that I told him, and I think I'd like to, tell everybody, is that, we don't rent stocks. We're business owners, and I want people to really think that way. It's really a mentality. to think like a business owner. And I've heard Buffett talk about this so many times about how so many people, so many investors in the world today really are in a stock if it's only for a short period of time, and it's only when it's going up, and if it has starts to trend down a little bit, they're out of the stock. And it's really difficult to really make money with that sort of attitude about stocks. Stocks represent ownership in a business. They're not just pieces of paper. You actually own a business. I love sitting down with my kids. I tell my son the other day, 13-year-old son, that he owns Google. He's a shareholder. He's a shareholder in Google. We have a little investment account for him for college, and he owns some stock in Google. He owns, like all of our customers do. He owns some stock in DaVita, in railroads, Canadian Pacific, and Berkshire Hathaway. I tell him, Berkshire Hathaway owns Dairy Queen, Geico Insurance, and these are businesses he's heard of. And I really think that if people can think like a business owner, and I think that would really help them a lot.
It's interesting you say that, because my kids and I went to Captain America this weekend. Great show. Made $160 million opening weekend. And I told my daughter, who has a small account that we help her with, you own Disney, which made Captain America.
Right.
And she got all, happy and all, excited. But for my 10 years of teaching investors how to manage their own money, I'd say probably 2 to 5% look at it that way.
Yeah.
Right? The majority look at it as, hey, I've got a technical pattern happening. I got to buy this stock. And they don't even know what they're buying.
Right.
Is that, so you're saying, as am I guess, don't worry about those short-term, you're going to be in the trade for 3 months. Focus on being an actual business owner.
Yeah, when we analyze, or when I analyze a company, I'm looking 3-5 years down the road, not 3 months, not 3 weeks or 3 days. And to give you an example, we've had several stocks that haven't performed very well over the last year. I haven't really changed my opinion about those businesses long term. I still feel very confident that they will be worth more 3 and 5 years down the road from now. And I'm looking at that as an opportunity, those downturns in stock prices. And that's an opportunity to buy more. If I still think the stock's going to be at, say, X dollars in the future, and now I can buy it cheaper, doesn't that make sense that I can buy it at cheaper? That's going to improve my returns down the road. And so, I just think these short-term market gyrations are an opportunity. It's interesting though, when you own the stock and it goes down, it's a lot different than looking at a stock when it goes down and say, oh, that's a great opportunity. But if all of a sudden you're in the stock and it goes down, something's wrong. The stock's broken. But if you don't own it and it goes down, hey, this is an opportunity. It's really weird how our mentality changes just because we own the stock or we don't own the stock. And it really shouldn't. I mean, if the stock goes down, and I think some people give the market too much credit. Like the market knows something that you don't. And I love this. This is a Howard Marks concept. He talks about this in his book. And everybody assumes that the market is all-knowing. And guess what? The market makes so many mistakes. Just look back in February. The market in February was, we're up 10 or 15% from the market lows in February. What did the market was wrong, in my opinion. The stocks got too cheap in February, and there were some opportunities. And I just think, people really need to think long-term, think like a business owner. And I would love it if people say, well, what do you do? Well, I'm in railroads, I'm in insurance, I own, I'm in healthcare, I'm in technology. Oh, really? What, how do you do it? Well, I'm a business owner. I mean, I would love that.
Yep. So in summary then, the words of wisdom that you're saying are under, and let me summarize this and maybe add some put words in your mouth. Tell me if these are wrong, right? If you look at it as a business owner, you're going to make fewer investments. You're going to make smarter investments. because you understand the business that you're buying a little bit better. And you'll be more willing to give those investments time to work.
Absolutely.
Which
Buffett has a great analogy. He believes, and I've heard him say this several times, that everybody had a punch card, a 10-hole punch card, and they could only have 10 investments choices during their lifetime. How much better would we be as an investor? We'd be so much better because we would really think about, before we invested, what we're buying. And, I think there's some truth to that. Now, maybe that's extreme, but I really feel like that's a great concept.
Yep, great. All right, my friend. So in summary, understand what you're buying. Spend time. You're a business owner. You're not renting a stock because of a little fancy price pattern that you may see in the stock chart or something like that, right? Invest smarter, be more patient, and ultimately the returns will come, because it is proven, and I mentioned this a couple minutes ago, it is proven over time that value stocks outperform these high, big name, popular name growth stocks over time. That's a fact.
Value does matter, and we look at growth as part of the equation of value, but at some, there's several stocks out there in the market today that are just, the valuations are crazy, and the current price is all based on its future growth prospects, its future earnings. It has nothing to do with its current earnings or profitability or balance sheet or anything like that. And those are the kind of stocks you have to be very careful about.
Like Tesla.
Yeah, absolutely. Don't want to mention names.
Not to name names. Right. All right, my friends. Thanks for spending a few minutes to listen to us today. As a reminder, if you have any questions, you can contact us. There's our contact information there on the screen. Brian, thanks for coming in for a few minutes and imparting some words of wisdom for our clients and anybody else that listens to this.
Happy to do it anytime.
And I'm sure we'll have you on again and again. Also, if you want to check out our website, www.igga.com. Thanks for joining us today, and we'll talk to you next month.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.